the title of this paper is Option Pricing, a Simplified Approach, and it is published in 1979. So it's pretty old, but by looking, but this is one of the classic in option pricing theory. So I'm gonna go over the first part with you, one by one, and then certainly at some point in time, I'm going into the mathematical things. But actually, you don't have to worry about too much because we already know all the details of the mathematics, which we are going to use today for this paper. So the first paragraph of this introduction is just an explanation of what option is. So an option is a security which gives its owner the right to trade in a fixed number of shares of a specified common stock at a fixed price at any time on or before a given date. So now I believe that most of you can understand what it means, but I just want to make one point on this sentence. So at the end of the sentence, it says, at any time on or before a given date. And it needs an explanation. Because the authors wanted to talk about the options, but what we know about the option is just one type of option. Of course, there are two types of options. The one is the call option, the other one is the put option, but we can classify options in different ways. So I'm gonna use the whiteboard. So we know that the call option and put option, these two are different options. But there is another way to classify options, which is defined by two different terms. So first one is the American option, and the other one is, am I right? It's, yeah, European options. So that I was talking about usually what I was talking about the options, I always refer to the European option, not the American options. The difference between these two options, the difference is that they all have the same maturity. So it has the maturity at T, and the European option also has a maturity at T. But for the European options, you can only exercise your option on the maturity date. That's why that's not the reason, but this kind of option is called a European option. In contrary, the American option is you can exercise your option on maturity date, but you can also, if you want, you can exercise your option at any time before the maturity date. So that's the difference between these two types of options. Of course, there are American call option and there is an American put option, and also European call option and European put option. So the difference is that when we can exercise the option makes these differences. So one is called the American option, the other one is called the European option. But here I'm mostly talking about the European options. But the author of the paper wanted to discuss these two different kinds of options altogether. So they use the word, so going back to the paper, they use the word at any time on or before a given date. So if they just wanted to talk about the European option, then they might say at a fixed price on a given date. But they also wanted to talk about the European option. So they, instead of saying that on a given date, they use the word at any time on or before a given date. So that's the difference. So, but basically this paper wanted to talk about the both of them, but I just want to make a focus on the European options. So when you read this paper, you will be you will encounter some paragraphs that you cannot understand from the viewpoint of the European options. Then just ignore that part, and that's okay. So we are not going to talk about the American options. And the next sentence says the act of making this transaction is referred to as exercising the option. So exercising the option. For the European options, you can exercise on a given date only. But for the American options, you can exercise your option at any time you want once you have one. So that's the difference. The fixed price is termed the striking price. So the fixed price is the price that I promised to buy, or the price that I promised to sell is called the striking price. And the given date is the maturity date. And so it has a different name, the same thing, but we call it with different terms. So sometimes we call it a termination date, or sometimes we call it the expiration date, and so on. And then the call option gives the right to buy the share, and a put option gives the right to share the share. So we know the difference. The call option is a right to buy the underlying asset, and the put option is the right to sell the underlying asset. And in this paper, the authors think that the shares is the only underlying assets, but you can apply the same thing to other underlying assets like the interest rate or the exchange rate. But usually the option was traded for the shares traditionally, so they focused on the shares, but you can also apply the same technique to all different kinds of options. And options have been traded for centuries, but they remained relatively obscure financial instruments until the introduction of a listed options exchange in 1973. And they said, yeah, option has a very long history, but usually the usual people did not know the options, but it it came to the world in 1973 by the introduction of the real exchange market for the options, the official the markets in the United States. And that year happens to be 1973. And strangely enough, that 1973 is also a very important year in the pricing of the options. So the next paragraph says option pricing theory. So this is not about the trading the option, it's about the theory on how to value the options, how to make the price of the options. Has also a long and illustrious history, but it also underwent a revolutionary change in 1973. At that time, Fisher Black is the first one, Fisher Black and Myron Scholes. So these two people present the first completely satisfactory equilibrium option pricing models. And this model is usually called the Black-Scholes model. And it was published in 1973, happens to be. And in the same year, the Robert Martin extended their model in several important ways. And Robert Martin is another contributor to the option pricing theory, but since he did not involved in the Black-Scholes paper, so Black and Scholes, they together write a paper, and then Merton write another paper based on the Black-Scholes model. But actually the Black-Scholes model, the mathematics used in the Black-Scholes model is heavily depend on the Robert Merton's paper, and actually they are all colleagues in the MIT at that time. So the Fisher Black was as I know of, consultant in the consultant in the MIT at that time, and Myron Shores is an assistant professor, so the very beginning year of the professor in MIT economics department, and Robert Merton, actually he was a PhD student in MIT, and they knew each other. And for some reason, Black and Shores wrote a paper together, and Merton wrote a separate paper. And later, these three people, but actually only two, the Shores and Merton, got the Nobel Prize, and the Black did not get it because he died before the Nobel Prize. And the importance of their discovery is that, as these studies have shown, option pricing theory is relevant to almost every area of finance. So this is what I wanted to point out several times. So if you know the basic option pricing theory, and you actually can cover almost every area of the finance. So for example, virtually all corporate securities can be interpreted as portfolios of puts and calls on the assets of the firm. So indeed, the theory applies to very general class of economic problems. So you can actually explains almost everything in finance. But the problem is here, unfortunately, the mathematical tools employed in the Black-Scholes and Merton's article are quite advanced and have tended to obscure the underlying economics. And their model is use a lot of advanced mathematics, so-called Brownian motion, Ito calculus, and all kinds of things. But the reason why I'm talking about this paper is that the author, the CRR paper, skip all those advanced mathematics, and they just use some elementary mathematics. So they said that it is possible to derive the same result using only elementary mathematics. So I'm gonna use their elementary mathematics, but as you read on, you can realize that this is not just elementary. It's at the end of the paper, it's quite advanced, but up to the middle of the paper, and it is actually elementary. You can only need some plus and minus, multiplication, division, and some log and exponential, that kind of thing is enough. So in this paper, the CRR will present a simple discrete time option pricing formula, and the fundamental economic principle of option pricing by arbitrage method is particularly in this clear. So that is the end of the introduction of this paper. And then later they said the next chapter, the next sections explains this kind of thing and this kind of things. So we are moving on to the section 2, the basic idea. And I don't think you have any questions for the introductions. So I just skip the Q&A session, and then I just go to the basic idea. So just think about the numbers in this section. So suppose the current price of a stock is $50, and at the end of a period time, its price must be either $25 or $100. So right now it's $50, but at the end of the one period, which means when we toss a coin, it can be either $100 or $25. So it depends on the coin tossing. And then a call on the stock is available with a strike price of 50. So let's suppose that we have an option, a call option, and that call option has a strike price of K, and K is K just said that the K is 50. So before I move on, just think about the payoff of this call option. So everyone remembers the payoff of the call option, and it was max st minus k comma 0. So this is the payoff of the call option, and remember that this is the payoff at the maturity time. So here is t. So if I draw the current situation with the numbers, so we can say that the current stock price is 50, and then it can goes to 100, or it can goes down to $25. And then you have an option here. And then that option price also can go up or down depending on the outcome of the stock price, because this is the maturity of the option. This is the maturity date of the option. And according to this payoff, it is just max ST. But what is a ST here? The ST is this one, right? Because assuming the coin shows a head, that means the stock price shows you a head. So that means it's $100 minus, and K, we assume that K is 50. So it's 50, comma 0. So that is the payoff on the upstate. And then payoff of the downstate is basically to use the same formula. So max, and then the ST in this case is 25 because it's in the downstate. So it's 25 minus 50, comma 0. And as you can see, this is the negative number. So basically, C turns out to be 0 here. Now go back to the paper again. So the first two sentences tells that the first sentence is talking about the game of a stock, and the second sentence says there is a call option depending whose underlying asset is the mentioned the stock price. And then we need one more thing. It is also possible to borrow and lend at a 25% rate of interest. And you may think that 25% is too big, but that number is just for the convenience of the calculations. So what I mean by convenience is that now we have the first game and we have the second game, but in our terminology, in our example, the first game is here, and it should start with 1, and it says the interest rate is 25%. So 25% is a quarter, so it's basically 1.25 here. It's 1.25. So if you put $1 in the bank, at the end of the one period, you will get 1.25, and at the end of one period in the downstate, you will get this number. And if you borrow $1 from a bank, then you have to pay back 1.25 and then 1.25. So we already know how to price these things. So this is the first game, and this is our second game. And this is the third game we are interested in. So for this game, we want to find the value of the C using, say, replication or error-driven securities or risk-neutral valuations. And we already know how to do that. But in this paper, we can go to directly to the applying the method we learned, but they explained it in a little bit different ways, but the answer will be the same. So let's just follow their explanations. So here, okay, so it is also possible to borrow and lend. So the only one piece of information left unfurnished is the current value of the call C. So we know the current value of the C, but all the other 8 numbers. So here altogether 9 numbers. The first 3 number is for the bank. The second 3 number is for the stock. And then in the final third game, we don't know the current price of the stock, but we know the upstate value and we know the downstate value. So the only information left unfurnished is the current price of the call. And they said, however, if riskless profitable arbitrage is not possible, so you know the meaning of the arbitrage. So by assuming that there is no arbitrage, we can deduce from the given information alone what the value of the call must be. So if you assume that there is no such a riskless profitable arbitrage, then with all these 8 numbers, we can always find the only one unfurnished information, and that number must be the value we are going to calculate. So in order to explain this situation, the authors write 3, where is, okay, 3 different things. So, well, for some reason I cannot select this part, but in the box, they said 3 things. So let's just read one by one. So write 3 calls at C each. Here, the write is the old terminology, and that means you are in a short position. So write means sell the call options. And we don't know the current value of the call option, but let's just make a portfolio, take the short position of 3 calls. That's the number 1. And the number 2 is to buy 2 shares at $50 each. So we know that the current price of the stock is 50, and we are going to buy 2 shares of the current stock. And then the third one is borrow $40 from the bank at 25 interest rate and to be paid back at the end of the period. So these 3 things, so these 3 things is actually to take the positions in 3 different games. So, okay, I want to take the position in the first game, say it's a long, and take the short position, take the short position in the second game. And actually, the authors explains the, very uh, mm, this is the terminology that usually the bankers use, but we don't worry about what do you mean by the leveraged hedge. It's just a name. So from from my interpretation, these 3 is just take the positions. And then you can think of this position from the cash flow point of view. So the table 1. So let's take a look at the table 1, and we are going to interpret each number one by one. So on the left most column, So the first one is write 3 call and buy 2 shares and borrow. So these are the 3 positions we are going to make. And then on the right hand side, this column is the present date. So this is the cash flow at present day. And then expiration date means it's 1 point time later. And then since we are tossing a coin, it can be either downside or either upside. And depending on which state we are in, the cash flow will be different. So let's just look at the first one, the present value. So write 3 calls. The price of a call option, which is unknown right now, is just a C. And if I sell 1 call option, then I will get $C. But since I'm going to sell 3 of them, the money that I get. So please think about this money from the cash flow point of view. Later, we are going to use the another point of view, but right now, we just think about it as a cash flow. So since you sell 3 call options, you will get 3C. So that's a positive number. So I take the money and into my pockets. And then I'm going to buy 2 shares, and 1 share, the price of the 1 share is $50, and I'm going to buy 2 of them. Then the total money that I'm going to pay is the $100. Then $100 came out from, it goes from my pocket to the other guys. So from my cash flow point of view, it's negative 100. And then I'm going to borrow a certain amount of money from a bank. So borrowing the money, of course, I have to pay back. But right now I have a income cash flow, so it's $40. So that's the present cash flow value, the present time cash flows. And then on the expiration dates, let's think about when S is equal to 25. So they said it's S star, and it's basically the same as the ST for our case. And think about how can we settle down each positions. So ST is 25. For the call options, you are in a short position of the call option. And just think about the payoff of the short position of the call option. And the future price in this setting is either $25 or $100. So maybe I can draw a picture. So this is the payoff diagram, and then call options payoff diagram looks like this. And this is for the continuous case, but in our example, this is 50, which is a strike price. And then in this simple model, the price can be 25 or it can be 100. There are only 2 things happen. And for the down state, you assume that the price is 25. So for this short position of the call option, I don't have to worry about the call option at all because it expires. So I don't have to pay anything to the holder of the call option. So that means it's nothing. Now I'm gonna take the another position for the for the stocks. And since I bought 2 stocks, but on the expiration date, I'm gonna no matter what, I'm gonna sell it back. But the price of each stock is $25, and I have 2 of them. So what I get is just $50, 2 times 25. And then here, I have to pay back my money to the bank. And I borrowed $40, and the interest rate was 25%. So actually, the interest is $10 for $40. So if I add the principal and the interest, that will be total $50. So I have to pay back $50 to the bank. So it's minus 50. And when you add these three numbers, the first one is 0, the second one is plus 50, the last one is negative 50. So if you add these three numbers, it is 0 basically. So now I know that, okay, on the expiration date, if the downstate happens, then my overall cash flow is going to be 0. Now let's think about the upstate. The underlying asset goes up to $100, and I have to reset my all positions. So for the first one, I sell 3 calls. And since I pay call options, but in this time, the underlying asset is $100. So for every call option, I have to give $50 to the long position of the call option. So that's why, in this sense, I lost $50 for each option, but I sold 3 of them. So in total, from my pocket, I have to take $150 and give it to the long position of the call option. So that's negative 150. Now I'm going to take care of my stock, and I have 2 stocks, and each one goes up to $100. And if I sell back, I will get $200 to my pockets. And for the bank, for banks, it doesn't matter whether stock price goes up or goes down. I have to pay back the same amount of money. So that's the meaning of this last column. But again, when you add these 3 numbers, you will get 0. And this is the clue. So at the beginning, you set up a certain portfolio, and at the end of the period, whether it goes up or it goes down, you don't have to pay anything. Then, since we assume that there is no arbitrage opportunities, then that means the current value, the cost of building the current portfolio should be 0. So that means 3C, here is the equation. 3C minus 100 plus 40 should be 0. Otherwise, there is an arbitrage opportunities. But this is just a simple equation for the C. So once you solve this equation for C, the price should be $20. And that's the answer. So it's just and then there is some more explanations. If the call were not priced in 20, so if the no arbitrage price is $20, but what if the price were $25? Then just do it. So because it should be $20, the one call option should be $20, but it's $25. Oh, okay, that's great because it's expensive. It's higher than the expected value, higher than not the expected value, higher than the no arbitrage value, then you are going to sell. So actually, this portfolio sells 3 call option. So actually, it gives you. So when you plug in $20 here, the first one is going to be for the 20 it's 0. But if you plug in 25 here, then it's a 75, and minus 1 is 20, negative 25, and it will gives you $15 in your pocket. So once at the present time, you will get $15 in your pocket, and at the end of the period, you don't pay you don't have to pay nothing. That's the arbitrage. So the 25 cannot be the no arbitrage value. And then it also explains that what if the price is less than the equilibrium value? Then you have to take the opposite position. So you have to buy the option, not sell the option, buy the option and short two shares and then invest money. Then you will get the profit also. So it's just the explanation of the how to make the arbitrage if there the price is not in the no arbitrage price. And there is they explain something, and here is one thing. So what's maybe okay, I'm gonna read from here. What may seem more incredible is what we do not need to know among the other. We do not need to know the probability that the stock price will rise or fall. Okay. So I did not say anything about the probabilities. I just said the coin shows up head or coin shows you a tail, but it doesn't matter. So whether it's a half or whatever probability, the price must be the same. So that's the end of section 2. And now I'm going to wait your questions. Okay, we already have a question. Explain one more about the first row of the table, right? 3/4. Okay. Okay, I'm gonna explain. I think I can explain these two together. So why we should pay 150 for selling 3 calls on the expiration date. And this is the what do you mean by 3 calls? Okay. So we it's $50. That's 125. It's for the stock. And there is a call option. And for the call options, and there are 2 people involved. So one is in the long side, and the other one is a short side. And you know what means by long and short. The long side people gives money to the short side people, and that money is C. And the amount of money is the price we are going to find. And then in the paper, it says write 3 calls. And it means actually it's a take a short position in 3 calls. So short position. So since we take the short position, we can get money from the long position people. And each one is $3. So from the cash flow point of view, I can get 3 times C. And it turns out the C is 25, later. But at the beginning, we do not know this value. But, well, let's suppose it's $25. Then you sell the options, sell the call option, and then receive $75 in total. And then since you sell something, actually you sell the right to buy. So you sell the right to buy. So this guy has the right to buy. So right to buy what? Right to buy the underlying asset, which is this stock at the end of the period, at the price of 50 for each one. And he has 3 of this right. because you sold the 3 call options. So at the end of the period, the price can be either 100 or 25 $100 or $25 for the underlying assets. And just think about, it's easy to think about the long position side. And once you understand how much long position side will get, then that amount of money is you have to pay to him or her. So what we have done first is, okay, what if the stock price is 25? And if you are in a long position, then you will get this amount of money, 25 minus 50 times 0, which is 0. So if you're in a long position side, then you will get 0. That means when you are in a short position, you owe $0. So that's why we have 0 here for the $25. And then if you are in a long side, then stock price is $100, but you have the right to this 100 worth stock by just paying $50. So for each one in the long position, you have $50 profit. That means if you are in a short position, you have to pay $50 to him for each stock. And then since you sold 3 core options, you have to give him $150. So that's why the value here is negative 150. Or you may think that, okay, so that's the, you may think that, yeah, why should I give him $50? But actually, you do not give him $50 in the real sense, because it's $100 and $25, and you are in a short position, and there is a long position guy, and he has a right to buy $100 worth stock with the price of 50. And you have to, and actually that right is a right to you. So you have to sell in this way to the your stock in $50. But when you are in a short position, you don't have this stock. So you just buy $100 stock and then sell him at $50. So that means for each one you are losing $50, because this one is higher than the, so this is the in the upstate, this is the real price, and you promise to pay. You promise, you gives him a right to buy the share at the price of 50. So when he exercises his right, and you have to buy this thing and then give it back to the long positions. I hope you can understand. And if you don't, then just ask me some more. Okay, Mark has answered. And what else? Okay, why should he pay 150 for selling 3 shares? Yeah. This is what I explained. And go back to the question. Okay, can you repeat the borrow part about negative 50 and negative 50? And actually, that's very simple. If you borrow the money from a bank, you have to pay back with your interest. And since the interest rate here is 25%, so if you borrow $40, then the interest is $10. Of course, it's a lot. So, so yeah, you have to pay back $50 in either case. So whether stock price goes up or stock price goes down, you have to pay the same amount of money to the bank. And that's it. So I'm gonna mark it as answered. And then can you explain about the adaptation of the concept of long and short and call and put? Uh, a little confused. And actually you are much confused about the concept because it's not at the beginning, it's not easy to adopt this concept. So first of all, I would like to say that I did not use the put option here. I just used the call option in this case. And then remember what we have done for the call option here. So for the call options, so if you remember, I said this was the forward contract, and we can separate these things into four different parts. And then this guy, the 1 and 2, is about the put option. But since we are talking about the call option, it's about 3 and 4. So this is the long position of the call option, and this is the short position of the call option. And since our problem is not talking about the whole line, it just talk about just 2 points. So one is 25, the other one is 100, and one is 25, and the other one is 100. So maybe this picture, this diagram will help you understand. Oh my gosh, I just, let me go back to the Menti. I just close it. Okay. So, yeah. Oh, yeah, I like Zoom meeting more than the direct class. But if you have a direct class with me, then you will be also happy. I think a short position of the call option always results in minus profit no matter the price goes up or down. Then why do people choose it? Okay, that's a good question. So that's why you get the money in front. So, okay, okay, I'm going to read, another one. This one is the long position. This one is the short position. This one is long, and this one is short. So just remember that when I first introduced the long position and a short position, the short position is not always negative, but sometimes it is zero. But still, short position is always worse or equal to long position because if you are in a long position, you will get a profit or nothing. If you are in a short position, you will get loss or nothing. So everyone wanted to in a long position if there are no money exchange at front. So that's why that's why if you wanted to in a long position, you have to pay some amount of money to the short position people. So that's the money. So uh, how much the long position people should pay to the short position people? This money is called the option price, the call option price. And in some sense, even if you get this amount of money, you might not feel uh, good when you take the short position. And there is a magic in that. So when you get this amount of money, then not very much, but when you know the how to replicate something, then with this amount of money, you can actually eh, you are not going into lose any money at all. So that's the point of what I'm going to explain with this the call option price. But if you did not get it yet, that's okay. We are going into more details. So I think yeah, that's the answer for this one. And then oh sure, yeah, I can share in some day. And this kind of thing, actually, if you have a chance to meet directly, then this kind of thing is uh, it's much more fun because I can explain some mathematics or some conceptual things without looking at your face. But if I wanted to tell my experience, then I prefer to I prefer to see your faces and how you react. So that makes me to talk much better. So yeah, we can have definitely have some chance to do uh, to talk about this kind of things. Yeah, because I think. Oh, actually, yeah, I did not say about. Oh, I'm sorry. Yeah, I forgot to. Yeah, I did not say about the final project fully, but later in this class or today's class, yeah, I'm gonna tell you a little bit about the final project. Okay, that's great. Okay, I'm gonna go a little bit faster. Now, since you understand the, that's okay. Even if you don't understand yet these things, it's okay. So what I really wanted to talk about is this picture, this diagram. So S is the current price of the stock, and when it goes up, it's not just US. It's actually it's a multiplication. So U is some number. So for example, if you just to remember what we have done with the numbers, the stock price was $50, and when it goes up, it's gonna be $100. That means it's 50. S is 50. And here U is 2. So 2 times 50 is 100. And here the S is 50 still, but D is a half, a 0.5. So this number is 25. Of course, yeah, U and D. So how can you determine the U and D? And there is a very uh, a plausible way to make the value of the U and D later, but we just take it for granted. So somebody gave me that number. U is say 1.1 or D is say zero point 0.9 because we want to have in the upstate, we wanted to have some much more bigger number than the S. And for the downstate, yeah, we wanted to have some smaller number of the previous sum. But actually, it doesn't matter whether all goes to the up as long as this one, the upper part, is bigger than the lower part. And then intentionally, these authors assign some probability Q. So usually we denote the probability as P, but here the authors intentionally introduced the Q because they wanted to use the notation P for different probabilities. So they just said Q is the probability of these things happen, and it is actually the subject probability. So everyone here, yeah, I'm just here, but every students have a different Q. But whether the Q is, as long as it's a probability, it's okay. So this is the first setup. And then also we need, what we need is the bank. And this is just the stock. And we are going to have a call option. And for this, I prepare a YouTube video without any sound. So let's see. Okay. So first one is the stock. The second one is a little bit strange because usually when we use the notation R, that means the interest rate. But strangely enough, the authors use 1 plus interest rate as R. So this R is not the number like point 0.1 or 0.01. Actually, the R is always greater than 1 because it's 1 plus the interest rate. So you may think this R as 1.1. And important thing here is that whether it goes up or goes down, it is still the same amount. That means if you borrow $1 from a bank, then you have to pay back 1 plus something, not depending on the state. So that's the meaning of this second game. Or if you put $1 in the bank, then you will get 1 plus something and 1 plus something. And then the final game is this one. So the C at the current price of the call option is unknown. We do not know this value, but we definitely know these two values, even if it is written in mathematical formula. It is a known value. Why? Because we assume that first we assume that we all know all these 6 values. So S is the current price of the stock, and for U and D, somebody gave me these 2 numbers. So we think that those 2 are, we take those 2 for granted. So that means U times S is known, D times S is also known, and 1 is definitely just a number, and the interest rate is given. So 1 plus interest rate, 1 plus interest rate. So all these 6 values are given to us. So we know what US is, we know what D times S is, and we assume that this specific call option has a strike price of K and strike price of K. So the first expression and the second expression also is just the payoff of the call option. The difference is that the S sub t, the first argument here was the S of t, but remember that S sub t can be negative. No, it can be from 0 to all the way to infinity. And in this model, we just pick 2 points. So one is U times S, and the other one is D times S. So by assuming that these numbers are known, the CU, this CU is not the C times U, it's just a subscript. That means it's a up state, and the D means the down state. So here, this U is actually a different meaning. So the U in the stock price is just a number, but here in this in the subscript, it's just a notation. So CU is known, and also CD is known. And one more assumption here is this one. In this paper, assumes that the U is the biggest number here. This U is the biggest number, and the D should be the smallest number, and 1 plus interest rate is between these two. And that's actually the assumption of this model. And what if this assumption is violated? Well, then some very easy arbitrage opportunities are always available if this condition does not meet. So that's why we impose this condition for these three games to be an interesting one. So yeah, take it. Take it. And later, once you understand the details, then you can think about, what if this assumption is violated? Then you can easily find the example that you can use your arbitrage opportunities. So that is the setup of this problem. And then I made lots of video. So this is the setup. Okay, now we go into the one-step binomial tree valuations. Okay, now we know what this means. So here on the right, most right-hand side, the CU is a known value, and CD is also a known value. But the question is, how can we find the value of the question mark? And we want the value that is reasonable, that is in equilibrium, and that is rational, and that is arbitrage free. So no arbitrage price. And this is the game actually we started with. So just to remember, not in the paper, the previous week and the 2 weeks before, we talk about the $10 and you will get 11 and 11 and all that kind of things. And I introduced you 3 different ways to calculate the last value. The first one was the replication. And remember how we calculate the replications? So I'm gonna pause a little bit and just think about the equations first for solving this problem using replications. So which numbers should I take to make an equation? And of course, in this case, the equation is all written in notations. The answer should be a notation. And then just, take it. Okay. So if you remember correctly, so we take this part to our first vector, and you take this part as our second vector. And then what we did a week ago is that to calculate how much should I have for the first game and how much should I have for the second game in order to replicate the payoff of the third game. And then in that case, we use the notation x1 and x2. But here I use some strange notation, and this notation is called a delta. And this is another unknown variable b. So the reason why I choose these two is that it's simple, because the CRR, the CRR paper use these notations. But actually there is, so the second one is not so standard, but actually the delta here is very standard. What I mean by standard is that this one, why we use this one as delta, because my answer is because it is a delta. And you see what I mean later. So the lots of people in the real business world say that this is a delta. So I'm not sure if you ever heard of it, the delta hedging, that kind of thing is actually all refers to this delta. But for now, we just take this delta and B as just x1 and x2. And I think, yeah, you can solve this one. So by solving this one, this is the answer. And you can definitely do this one by hand. But for now, we just take those two solutions as given. And then how can I calculate this question mark? So remember that once we calculate the x1 and x2, and in order to calculate the current price of the third game, we just multiply this value to the current price of the first game, and this value to the current price of the second game. And by adding these two numbers, we can get the third number. And this is exactly the same. Yeah. So C, actually this question mark is C. And in order to calculate the C, you take the S and you take the 1 here and the delta and B. And then once you calculate this one, you will get the formula for the C. So this is the result of just plugging in this formula. But with a little modification of this formula, it shows us something really surprising things. Looks complicated, but you already know what it means, because this is just a risk neutral valuation formula. So what I mean by risk neutral valuation formula, the risk neutral valuation formula, there was some probability. So this one is just one probability in the parentheses, and this one is also another probability. How do you know that? If we add these two numbers, so the denominator is the same, and numerator, when you add these two numerators, the R and negative R will be canceled. So on the top part of this fraction is U minus D, and the bottom part is also U minus D. So that means if you add these two numbers, you will get 1. So that's the very important property of a probability. And then the second, do you remember the relationship between U, R, and D? U was the biggest number, and D was the smallest number, and R, 1 plus interest rate, is a number between U and D. So that means U minus D is a positive number because U is always greater than D. And the same is true here. But how about the R minus D? R minus D is always also a positive number because R was in between these U and D, but R was greater than D. So this is positive number. So that means the first fraction is a positive, and the second fraction is U minus R is also positive. So the whole thing is a positive. So they are all greater than zero, greater than zero. And if you add these two numbers, you will get 1. So that's sort of a probability. And then okay, that's the probability. And in order to calculate the P, all you have to do is multiply the risk neutral probability. Uh, you are not sure why this is the risk neutral probability at this time, but we just decided to call this probability as a risk neutral probability for now. So multiply the risk neutral probability and multiply the risk neutral probability and add these two numbers, and then take this guy into the current values, which means we multiply the discount factor. And discount factor is this one, 1 over interest rate, what, 1 over 1 plus interest rate is your discount factor. So actually this to solve this problem, we start with the replications. So we wanted to replicate the third product, the third game, by take some position on the first one and take some position to the second one. And that position turns out to be this delta and B. And I don't know whether it's negative or it's positive, but when it is positive, it means that I'm going to take the long position. And when it is a negative, I'm going to take the short position of that. That's it. And then once we know the each positions I need to take to replicate the third one, I would in order to calculate the current price of the third one, I just plug in those number into the by multiplying the current price of these two games, and this formula gives me the price of the unknown value C. But by just manipulating this replication formula, I can get risk neutral valuation formula. Well, there was a student who asked me how to get the second one from the first one. Uh, yeah, at first it looks very strange, but notice that it has a CU here and it has a CU here. And then another variable is CD and CD. So if you simplify this equation with respect to these two variables, CU and CD, then you will get this one. At first, it seems a little bit complicated, but it's not that complicated, because as you can see, the S here and S here will be canceled. So the bottom part is just a U minus D, and on the right hand side, it's a 1 times something, so it's basically the same thing, but it also has a U minus D times R. So I need to multiply R here, then you have the the common denominator, and then you can make some modifications. So that means you just take all the value, all the terms with CU on one side, and all the value with all the terms with CD on the other hand side, and then you can derive this formula. Okay, so this is actually the one-step risk neutral, one-step binomial option pricing model, and that's it. And I'm waiting for your question. Okay, I have one question. So K same as S. No. The K, okay, let's go to the whiteboard. So actually the numerical example is always helpful. Ah, I see why you think that the K is same as this one. But actually, and this one says it's 100 minus 50. So it looks like K is same as 50, but not necessarily. You can take, say, 20. So, so this K is called the strike price. And actually, when you really derive the option pricing formula, there are lots of call options with different K values. So for example, K, in this situation, K can be 125, say 100, and 75, 50, 25, 20. And depending on the strike price, the option price is all different. So in this case, it happens to be the same as the original S, but not necessarily. Of course, this is a very simple model. So for some cases, the option price has the same value here. But as we move on, so what I mean by move on is that we want to make it, we start from the one-step binomial tree, but today we are going to go to up to the n-step binomial tree. So as our binomial tree grows on, it will looks like this. Um, it will looks like this. U, C, D, C, U, U, C, U, D, and then some more. And in the final node, we have all different values. And this will be true for the S. So we first start the U times S and D times S. But as we move on, it has, say, 175 and 150, 125, and all of that. So as we make our n grows, it is becoming to a more and more realistic model. Okay, so that was a good question. Yeah, I forget why this is a risk neutral formula. You didn't forget. I did not explain. I just call it risk neutral probability. Yeah, for now. Oh, you forget why this is risk neutral valuation formula. So what was the risk neutral valuation formula? We talk about the replication. And this one is, take something and x1 plus, and take something and x2, and to make the third one. And by do something on here, you can get the price. And the second one was the error-double security. And error security is to basically it's to calculate the value of these two vector, and then so it's question mark 1 is question mark 2, and once you find the value of these question mark 1 and question mark 2, and you can build any product, any payoff using these two. That was the error security. And then risk neutral valuation formula was actually derived from this error security, but in the final one, I said this risk control formula, risk control valuation formula was this one. And if we write a little bit more, it's if I remember my number, it was P plus 11 times 1 minus P. So this was the risk neutral valuation formula with my example. So just remember that there was my example, my numerical example, and there are the CRR's numerical example, and now we are talking about the CRR notations. So I already finished up to here, because now you can see all the diagrams, and it's just what I have explained to you. So we are up to here, but I'm gonna answer your questions. So what does it mean to calculate the result from the risk neutral formula? Okay, first think about that in this way. I don't want to calculate the risk neutral valuation price. What I want is the price which is arbitrage free. So the only assumption that I made here, there is no such an arbitrage. So if we assume that there is no such an arbitrage, the price of that product, of that core option must be this value. So that's what I really want to emphasize. So I don't want to talk about the risk neutral probabilities. What I want is no arbitrage price, and that's it. And then the math people come to here. They come to here, and they said, well, that risk-free price can be derived using this formula, and they call it risk neutral valuation formula, and it happens to be the same. So sometimes people just forgot that we want no arbitrage price, but actually that is the point. So risk neutral formula happens to be the same to derive the no arbitrage price. So that's the so even if the risk control formula, we can calculate the value from the risk control formula, but it does not tell me. So it is just a formula, but actually that derived number has the meaning that if there is no arbitrage opportunities, then the price must be this value, and that can be proved by replication. So risk neutral formula does not provide any proof. So what does the middle 1 to R or R means? Oh, okay, the R. So I said it in this way. The R, usually we denote the R as the interest rate, but for this paper, the CRR paper, they use the 1 plus interest rate as R. So R is always greater than 1 because let's say the interest rate is 10%, then that R is 1.1 because the interest rate is 10%. And if the interest rate is 5%, then that R is 1.05. So that's it. The middle part means that amount that we deposit at bank. Yeah, you can think about in two different ways. So that's actually the deal with the bank. So you can make make a deposit with $1, and then at the end of the period you will get 1 plus your interest rate, and or you can borrow the $1 from a bank, and then you have to pay back 1 plus the interest rate to the bank. So that's the meaning in the middle part. Oh, no questions. And I'm gonna go back to the paper again. So this formula 2 is just calculate the delta and B. So it's one times B. And then plugging these numbers and you get this formula. And this formula can be interpreted as this one. Once we denote this part, the first fraction part as the P, the second fraction part is definitely 1 minus P because we know that by adding these two fractions, we will get 1. So if I call this part P, the second part should be 1 minus P. And then it can be written in this way. And then, yeah, there are some more explanations, but it's an explanation for the most of this part, the more explanation is for the American options. So I don't care about the American options. So you may just read the paper, and if you cannot understand from if you cannot understand based on my lecture, then either you cannot understand my lecture or just ignore it. Okay, so before we move on, I'm gonna share this part with you. So this formula has a number of notable features. And this formula is really simple, but it shows you a very, very notable, something very noticeable here. The first, the probability Q does not appear in the formula. And that's amazing, actually. So we talk about the Q at the beginning of the introducing the model. And the Q, I said, it's a subject probabilities. And then, or if you remember the two previous lectures, and I said, I'm gonna toss a coin, and the probability of getting a head is a half, and probability of getting a tail is a head, is a half, but actually it doesn't matter. And that's what I wanted to emphasize. The probability does not appear in the formula. That means, surprisingly, that even if different investors have different subject probabilities of an upward or downward movements in the stock, they could still agree on the relationship of C to S, U, D, and R. And this is amazing. We don't have to worry about the actual probability of getting a head or actual probability of getting a tail. It doesn't matter. The second is the value of the call does not depend on investors' attitude towards risk. And if when you learn something from the economics, then usually we assume some kind of utility functions, and then the attitude of the risk. But in constructing the formula, the only assumption we made about an individual's behavior was that he prefers more wealth to less wealth, and therefore has an incentive to take advantage of profitable, riskless arbitrage opportunities. We would obtain the same formula whether investors are risk averse or risk preferring. So it doesn't matter the utility function. Yeah, it does not depend on any utility function at all. The only assumption we made is that if there is a riskless arbitrage opportunities, somebody will take it. That's the only thing. Okay. And there are some more things, but what I wanted to emphasize is that the final one. So finally, observe that P. So the P, we define P as that fraction is always greater than 0 and less than 1, so it has the properties of a probability. And this part is really important. And I really want to emphasize that you guys are really great at English, so why don't you read read this sentence and think about what it means. So in fact, P is the value Q would have in equilibrium if investors were risk neutral. And this is the key point. Okay, now I'm going to tell you a little bit about the risk neutral probability. So this is the first time I'm trying to explain what risk probability means. We just use the risk neutral probability, the term risk neutral probability, and we just take it for granted. So we just use it as some different, as some just as some variable names, say X. But now I'm going to explain what it means. Risk neutral probability. So what do you mean by risk neutral? And if you search into Google for the risk neutral measure or something like that, then probably the first website that explains the risk neutral measure or risk neutral probability is going to be a Wikipedia. And I like the explanation in the Wikipedia, but I have a little bit different way to explain this one. The risk neutral means that there are two different products, and we know what it means, the product. And we say that, okay, let me use the CRR example, USDS and HS. And for the usual people like you and me, we have our own probability of getting upstate or getting downstate. But for the risk neutral people, this guy also has his own probability, But the why we call this guy is risk neutral is that he does not care once the expectation is the same. But we are different. So for example, I can make some qm minus 1q. And even if I get the same expected value for the first product and the second product, I always prefer there's something fixed, there's something constant. So I don't want to have these variabilities. But for the risk neutral person, he does not care whether it has a variability or not, as long as its expectation value is the same. So let me show you what he thinks. So this guy, the risk neutral guy, he has his own Q. He has his own Q on the up state. So since this is Q, the down state is 1 minus Q. And let's think about what his Q is. So how can you calculate this value? Well, let's see. I can say the expected value here is R times Q plus R times 1 minus Q. But actually, it doesn't matter because it is just R. Because Q and 1 minus Q cancels out. Okay. So, okay, this is okay. And then for the second one, what is the expected value from this risk neutral guy point of view? So it's U times S times Q plus U times S. And then here is D times S times 1 minus Q. Okay, so this is the expected value of the second game. And now suppose that now suppose that I have this amount of money, S. Then I have, not me, the risk neutral guy has two different opportunities. The one is that he can put S dollar in the first product. Then his gain will be R times S, because he put the S dollar in the bank, and then the interest rate is 1 plus interest rate, so he will get R times S if he deposit his S dollar here. But if he invests his S dollar in the second game, he will get, from the expected value point of view, he will get this amount of money. And I hope you agree with, I hope you follow me so far. And as long as these two, so this, we can say, yeah, this is also the expected value from the first one, and this is the expected value from the second one. And this neutral guy said that as long as these two value is equal to each other, he doesn't care whether he put money in the bank or whether you put his money to the stock. That's the ritual guy. But for us, and for me and for you, you are not satisfied with his view because this one is there is no uncertainty, and here there is an uncertainty. So there is some variability, but this neutral guy does not care as long as these two expect values are the same. So that's the meaning of the risk neutral guy. And I'm going to explain a little bit more, but I think I have a question. Uh, yes. Yeah. But for this one, but you have to think that the U and D and R has some special relationship. We made some assumptions, so you need to keep that assumptions. And then the C, okay, C. So as long as you keep the U, the relationship between the U, D, and R, then no matter what S is, of course, the uh, say the S is negative value, then I didn't think about too much. But as long as it's positive value and there is still a relationship, and the whether the risk, the probability will not be involved in this formula. Okay, so far I'm trying to explain what risk neutral guy means. So in the end, so it says that as long as these two formula is equal to each other, times S, and let me finish the formula. It's U times S times Q plus D times S times 1 minus Q. So the risk neutral guy doesn't care whether he wanted to invest in the first game or in the second game, as long as their expected values are the same. Then the question is, what probability make the risk neutral guy has? So my question is, what is his probability? Actually, we can solve his probability from these equations. So the question is, what is his Q? So we said that Q is a subject probability, and it depends on each individual people. But so for me, this equality does not hold, because even if the expected values are the same, I always prefer the uncertainty ones. That's me. I don't know yet whether you are agree with me, but if there is a risk neutral guy, the risk neutral guy doesn't care about the variability at all. Only he cares about is whether the expected value is same or not. So we are going to derive the Q using this formula. So as you can see, it all has S. So S will be canceled. Then, okay, before I write it here, so I'm gonna write R on the left-hand side, and this is U times Q, and here is D minus D times Q, right? So I can take this Q as one part, so it's D U minus D times Q. Then I can move it to the left-hand side, so it's D. Now I can write this formula in term with respect to Q. Q is just R minus D over U minus D. So if your Q is this one, then that means, okay, if your Q is this one, then 1 minus Q is obviously, yeah, that something. Then you are risk neutral. We can say that, yeah, you are risk neutral. And look at this one. And this one is actually this one. So I mean, this one. So that's why we call this valuation formula as a risk neutral valuation formula. So this is just a formula, but we may interpret this formula from a risk-neutral person's point of view. So by using his probability, we can take the expectation and then take the expected value to the current value by multiplying the discount factor. So that's why we call this value as risk-neutral valuation. But it does not mean there is a guarantee that there is no arbitrage opportunities when you calculate the risk-neutral valuation formula. What I can guarantee is that if you can replicate your products by replications, and that price is the risk, that price is the low arbitrage price, and it happens to be the same as the expected value formula from risk neutral person's point of view. So that's why we call it as risk neutral valuation formula.